This is FRM Part 1, Book 1, Foundations of Risk Management, and the chapter on financial disasters. We've been talking a lot in the previous chapters about the importance of identifying risk, quantifying risk, and managing that risk. And this chapter, which is called Financial Disasters, could be called, hey, let's talk about some examples of the violations of not identifying risk, not quantifying risk, and not managing risk. And so we're going to take a look at some examples in which all of the principles of financial risk management that we've discussed have been at least either ignored in part or in full that results in these financial disasters. And so what you probably want to do is know the details of each one of these disasters, but probably more likely be able to apply it to some fictional disaster that might show up on an exam. Now, the learning objectives are fairly straightforward. We're going to look at some of these case studies, and so this is all going to be descriptive in nature. There are no calculations, there are no equations, there are no formulas inside of this chapter. And so we'll take a look at each one of these over the next couple of slides, and there's a good number of slides in this slide deck. So let's go ahead and get to it. Let's go ahead and begin our introduction describing this concept of interest rate risk, which we have talked about in the past. A couple of components to interest rate risk, but the primary one that we'll talk about here in these cases is the simple fact that when interest rates change, they influence the value of a financial asset. Of course, the great example is that when yield to maturity on a bond goes up, the bond price goes down. This is called interest rate risk. Now remember, with a financial institution, we have assets on one side, we have liabilities on the other. So a change in interest rates is going to affect the assets over on the left-hand side differently and in the opposite direction as it will affect the liabilities over on the right-hand side of the balance sheet. And this can be illustrated with this savings and loan crisis that we had back in the 1980s. The chapter reminds us that these S&Ls were created by the U.S. federal government back in the 1930s. And notice the objective there, to facilitate home ownership. So lots of times governments and government bodies have really, really good intentions, but the application and the execution of those intentions sometimes has consequences, which we'll see here today. Actually, S&Ls go way, way back, maybe even 100 years before the 1930s, all the way back when states would allow some of their financial institutions to form as a savings and loan association. But the idea, even in the 1800s, but clearly after 1930s, the idea was to create these institutions so that individuals could go to a particular financial institution to secure a loan for their home, right? The idea is that home ownership provides stability inside of the home at the micro level, and then that expands out to the macro level of the economy. If there's people who are comfortable and satisfied and secure in their home ownership, then they probably have good jobs, and that probably translates into some good macroeconomic variables and an expanding macroeconomic economy. Now, of course, when the government gets involved, there's going to be regulation, and these S&Ls were heavily regulated. So they were not able to make commercial loans. I mean, they specialized in residential mortgage loans. There was an interest rate margin. Remember that financial institutions essentially, they borrow in the very short term, promising, let's just call it a low interest rate, and then they lend that capital out in the longer term, let's say at a higher interest rate, and that margin, that spread, was specified by the government regulations. Now, what that meant, in addition, was that these S&Ls had limited ability and hardly any freedom to invest any excess deposits or profits. Now, the cool thing about this from a historical perspective is that these regulations, they work fairly well, in the 1940s. Let's figure after World War II, in the 1950s and the 1960s. And so what happened was that they were providing these mortgage loans to residential homeowners. But then we hit the 1970s, and we had some recessions followed by higher interest rates, and then a dramatic spike in inflation. This is my memory of my high school days under the Jimmy Carter years of high rates of inflation, and my mother waiting in line to get gas on a every other day or so it seemed basis. So what happened was that the interest rates are rising, but these S&Ls were required to pay this kind of a fixed rate. Now, of course, when you take a look at the other side of the balance sheet, these higher interest costs were wiping out that interest rate spread. So the profitability was shrinking. And then when interest rates are high, of course, I tell my students this all the time, how could we possibly afford an interest rate that, say, 18 or 19% that was prevalent back in 1979, let's say? Oh my gosh, we currently live in a house that's this big. We'd probably have to live in a house that's this big. And of course, when interest rates go up, the outstanding mortgages lost value. All right, so there's a series of, let's call them supply and demand or macroeconomic events that were couched inside of this regulation and the regulatory environment that caused these S&Ls to suffer. And so, of course, the U.S. government stepped in and they said, you know what, how about if we relax some of these regulations? And how about if we increase the deposit insurance? And how about, and here's the cool thing, how about if we allow S&Ls to pay interest continuously? And this is what I remember learning in my Master of Science days from a really, really awesome money and banking professor, that the S&Ls were allowed to pay interest continuously and commercial banks were not, for a relatively short period of time. Now, you guys know from simple mathematics, and let's do a quick example here. If you start with 100 and your interest rate is 10% a year, and interest is compounded annually, you're going to get $110 at the end of the year. But if interest is compounded, let's say semi-annually or quarterly or monthly, et cetera, you're going to get a slightly higher number. And so S&Ls took advantage of this. They said something like, look, we're going to compound interest every instant, every instant of every day. Imagine. I mean, they made it sound like you would have $100 today and you'd have $1 million by the end of the week. And of course, that's not true. The maximum compounding continuously is that $100 can grow into about $110 and 51 or 52 cents, depending on how you round. I can trust that you guys can do that in your calculator. But look at that bottom block point. Instead of these changes helping the S&L grow out of their problems, they ended up making it worse. There's a good word, exacerbating. Now, of course, when there's an increase in this deposit insurance, it led the S&L managers to pursue even riskier projects, right? Riskier lending and investment activities because they knew there was a backstop. This is called moral hazard. And so these losses were about $160 billion. And of course, $160 billion today is a lot more than what it sounded like all the way back in 1987 or whatever year this was. All right, so what are these lessons that we can learn? Oh my gosh, regulation is good. I tell my students this all the time. Of course, all sorts of markets need rules and regulations, but we need efficient rules and regulations. So notice that first lesson. Over-regulation can be dangerous. How about this one? Without strict monitoring, of course, deposit insurance can have unintended consequences. It can result in increases in market indiscipline. And then we have to worry about the decoupling of the value of the assets and the value of the liabilities. This is why we spend so much time on asset liability management, because, boy, if there was a perfectly one-to-one correlation between those two, then we wouldn't have to worry about any of this stuff occurring. But of course, that's not the case. And in fact, those correlations can be, I imagine in the extreme case, they could be zero, maybe even negative under some cases. But as a good financial risk manager, notice that last point down there. Those banks' assets should be highly correlated with its liabilities, so that when interest rates go up, then those things move in similar fashions. Let's move on to funding liquidity risk. This refers to the likelihood that a bank is going to be unable to settle its obligations with immediacy. That's important. Let's take a look at just a simple financial institution. Let's suppose I have Jim's bank, and I take in lots and lots of deposits today, and I make lots and lots of loans, and I have $10 in cash. Let's just suppose that's my reserve requirement. And during the course of that day, I have 3 or 4 customers walk in, and they each withdraw $1. And I have 3 or 4 of my creditors come in and say, hey, Jim, you owe me $1 in interest. So what did I have? I have $10 in cash, so I can pay my deposits and I can make my interest payments with immediacy, right? So that sounds like very little funding liquidity risk. But suppose instead of 3 or 4 of them coming in and 3 or 4 interest payments due, suppose it's 6 or 7, so that I have $10 in cash and I have $14 in a liability. So with immediacy, I don't have, $10 can't meet $14, but what I can do is go over to the short-term markets, and I can issue some commercial paper. I can talk to the central banker. I can talk to my neighbor bankers. I can do all sorts of things to access cash so that I can pay that extra, what did I say, $3 or $4. So funding liquidity risk combines, the cash that's on hand, the cash flow generated by the assets of the financial institution, and this might be even more important, the ability to go out and borrow that money in the short term. So roll over that short-term credit. So what I just described there are those two sources, external market conditions and structural balance sheet risks. Let's take a specific example here of the Lehman Brothers. I'm guessing that even some of you younger individuals out there have heard of Lehman Brothers, even though they haven't been around for about a decade now. But Henry Lehman was a guy who opened up the Lehman Brothers store, 150 years ago. It was actually some kind of like a general store. But as his children and grandchildren and great-grandchildren evolved over the years, they moved into the financial arena. And going back to probably the 1980s, Lehman Brothers was not really the first to start this, but they really, really piled it on with this model that's known as originate to distribute. And so the idea is just to make a loan and make a loan and make a loan, and then package those loans into some pool of securities and then sell them to recoup all of those assets, right? And so the idea kind of works well if those mortgage-backed securities are funded by the deposits of the financial institution. But Lehman relied heavily on long-term debt, loans and bond issues to fund its operations. And so Lehman Brothers, as you can imagine, made substantial cash flows during the decades of like the 1990s and even the early 2000s. But once that real estate market started to surge in the kind of the mid 2000s, boy, they were really writing lots and lots of these mortgage-backed securities and selling them essentially all over the world. And look at that circle, that first circle point I have, an asset to equity ratio of about 31-1 by mid-2007. And then, of course, if you take the other side of the balance sheet or you do the inverse, whatever, that's an extremely high debt to equity ratio. Now, of course, when you have all of that debt, one of the ways to manage that debt is to go into the repo market. And, the repo market is, in its simplest scenario, works like this. Let's suppose that I'm Jim and I'm just a financial institution and I have a treasury bill that's worth, let's say, $95. But I don't have any cash. So I agree to sell it to you today and you pay me $95. So now I can take that $95 and I can do something with it. I can do something with it overnight or over the next week or over the next month. But the idea is that I'm going to agree to repurchase that treasury security from you at a fixed price. So maybe I'll agree to repurchase that from you for, let's say, $97 in a week's time. All right. So now who are you? You're somebody who has lots of cash and you want to generate a short-term rate of return. All right, so what happens? Over the next couple of days, I take that $95 and I want to try to turn it into, let's say, $98. So I take the $98 and then I take 97 of that and repay you. I have my treasury security back, plus I have $1. But essentially that repo market is really a bet on interest rates. I mean, what am I betting? I'm betting that interest rates fall. And let's suppose they fall substantially over these next 3 days and I buy that security back from you, which is now worth, let's say 100, right? It's a discount security. I called it a treasury bill. Let's just suppose it goes up to its par value for some strange reason. It goes up to 100 and I buy it back from you for 97. Now I have something. I made the $1 in interest and then I can generate a capital gain as well. And so what Lehman Brothers was doing was constantly rolling over their debt in this repurchase market. Now, of course, when the housing market burst, then those mortgage applications declined. Of course, there was a constriction in the market, and those mortgage-backed securities, those values, they fell, and they were unable to go back into the repo market or any other market, and they were forced into bankruptcy. There's the date, September 15th, 2008. One interesting note is that the government officials allowed Lehman Brothers to file for bankruptcy, so they no longer exist. But other financial institutions were bailed out or taken over. Let's go back to when I was in college, this Continental Illinois National Bank and Trust Company. And so this is really the father of the idea of the too big to fail. One of the things that happened back in 1984 is that Continental Illinois made arrangements and business partner ventures with lots of other banks throughout the world in which they would say something like, look, if you make these loans, we'll go ahead and buy them from you. This was a way of Continental Illinois to, maybe kind of diversify their portfolio to reach markets that they were unable to reach before. So look at that second circle point there in the middle of the page. Through this arrangement with the Penn Square Bank, Continental Illinois purchased $1 billion in what are now known as speculative energy-related loans. Speculative because they relied on the price of oil. And we know from our previous discussions that the price of oil goes like this, right? It goes like this, over extended time periods. That's why oil futures contracts are so popular with companies like, ExxonMobil and Southwest Airlines. But what happened is that in 1982 and then leading into 1983, there was a big drop in the price of oil. And I know this to be true because I was a big fan of that TV show Dallas, and J.R. Ewing, those of you who are old enough to remember that, Ewing Oil lost lots and lots of money when that price of oil fell. Well, so did Penn Square Bank and Continental Illinois. Now, one of the interesting things about this case is that it wasn't like the Lehman Brothers where, okay, we've lost all this money and it's time to declare bankruptcy. That happened in a relatively short time period. This did not. I mean, the funding dried up, and Continental Illinois talked to the regulators, and they talked to lots and lots of different people, and they tried to bring their position back up to being profitable, but it took all the way until the early part of May of 1984 for this insolvency to become a widespread event. And so look what I have at the bottom there. In 1 week's time, $10.8 billion was withdrawn. So imagine, let's go back to my bank. I'm Jim's bank. I have $10 in cash, right? And there's $10 billion worth of people trying to withdraw their cash. What am I going to do? I just throw up my hands. And so Continental Illinois was rescued by, a host of other people. One of the entities that it did lots and lots of negotiations with was the Fed, but the Fed didn't actually bail them out. It was more the FDIC and some other banks and some other regulators. How about if we look at an example that's not United States based? So let's go over to the UK, Northern Rock, and this is a pretty standard one. The bank's investment profile looked a lot like Lehman, large-scale sale of mortgage-backed securities. But what it did is that instead of financing with customer deposits or something relatively low risk, it borrowed heavily in the international money markets and capital markets, particularly with this interbank market. And so when the bubble burst, all of their funding channels dried up. The UK authorities came in, tried to assure, but this was not going to work. And so there was a huge capital injection. And then there was public ownership of Northern Rock. So here's probably a good slide to memorize about lessons from funding liquidity risk and identifying and quantifying and managing that risk. Yeah, reliance on short-term loans is probably not a good strategy. Too big to fail can have unintended consequences, as we're seeing today. We saw this in 2007, and we're seeing it even up to the late 2010s, right? Rumors alone can bring down even the biggest of banks. Of course, this is what we're talking about here in all of these chapters in the FRM program. What we're trying to do is figure out what kind of stress testing can we do so that financial institutions are able to handle these low probability events that have high potential losses. Notice in the bullet point that's bolded there, avoid high leverage. Boy, I tell my students all the time about the beauty of leverage and the ugliness of leverage. Now, of course, the duration of our assets and the duration of our liabilities, we do this whole thing about duration matching. And one of the easiest ways to duration match is to just have short-term maturity on their assets. And then it's always good to have an emergency liquidity cushion. This is one thing that I do in my family, and I try to teach my children that, let's have some emergency cash available for whatever it is that we need, and that can be applied to what goes on in financial institutions. Let's take a look at some hedging strategies. So this is what we're doing, right? We've identified the risk, we've quantified it. Now we're in the point of managing the risk. So how do we manage the risk? We did this in another chapter where we said something like, well, we can just accept the risk or we can try to transfer the risk. So that's what we're doing with hedging here. But in order to hedge efficiently and effectively, the hedgers have to have access to all the relevant information and tools like financial reports, market data, analytical software. You guys know that I've mentioned those Bloomberg terminals that we have access to at our school. Have to make a choice between static hedging and dynamic hedging. Remember, static hedging is just an example in which we know what this risk is today, and then we take a position, and then we just wait until the end, and we figure it's going to work out in the end. But that sometimes works, but a lot of times it doesn't. So we need to be aware of all the possibilities of dynamic hedging, and that's why things like the Black-Scholes-Merton option pricing model with its computation of delta are so extremely helpful to execute these dynamic hedges. And then, of course, we need to decide, are we hedging for 1 day or 1 week or 1 month, keeping in mind that there are implications for the financial statements, and there are implications for our tax liabilities. Now here's an example of a hedging strategy. This German firm, Metallgesellschaft, This firm goes back about 120 years, 130 years, and it was really just kind of a mining company. But over the years, whenever you have a commodity, what did I do with the price of oil? Price of oil goes up and down. So the price of commodities do that. And so any good manager in a commodity firm is going to be aware of the value of derivative securities. And so what this company did, they're known as MG throughout the world. What they did was they tried to insulate from the volatility associated with these commodities, in particular the price of petroleum. And this is what MG would do. It would agree to sell at a fixed price in some certain year, 1991, 1992, whenever that was, a certain amount of petroleum every month for a long-term period. All right, so these are forward contracts. Now, what it did to manage that risk was to use the near-term futures contract to go ahead and make certain that they were able to handle and honor their original contract. And so as long as the futures price was above the spot price, we call that backwardation in futures markets, then there was a profit to be made. And MG made a profit. Look at that bottom circle point. Oh my gosh, $3 and $5 for every contract. So this sounds an awful lot like free money, right? But what did we just hear? What did we just hear about the price of petroleum for previous examples? Boy, we know that it fell sometime during the early 90s. And so this is exactly what happened with MG. What it was doing was this stack and roll hedge that it would, now remember, it's doing this for, it's writing these forward contracts for, let's say, a 10-year period, and it's hedging them with short-term futures contracts. So maybe this is a month out, or maybe it's 2 months or 3 months out. So what it would do is it would take a position in those, let's say a 3-month contract. And then what it would do is it would roll that over, but it would purchase fewer and fewer number of contracts. So what you should be thinking is that, Jim, this sounds an awful lot like there's going to be some timing problems, right? We're making this long-term commitment, and we're doing it by stacking these futures contracts in the relatively short time period. Now, of course, over the life of this hedge, these cash flows would have probably canceled out. But if you're losing lots and lots of money today in the short term in the futures contracts, and remember, these contracts are mark to market, they're going to be forced out of their positions. This is what I have in the bottom block point. Forced to cash out its positions, incurring a loss of $1.5 billion in the process. Oh, sorry about that. And so as long as the futures price was above, so what does that mean? The futures price means that somebody's willing to pay for storage, right? That cash and carry model in the futures market. But if the futures price goes below that spot price, so to speak, in this case, well, then that's called contango, and then there's a big problem. And that's what really caused the MG's losses. I learned about model risk back when I was in the stages of writing my dissertation, when I collected data for about 15 or 1,800 firms. What I did was I used some good data, and I estimated a stock's beta. And I did it over several different time periods. And I went to my professor and I said, if I use a 6-month window or a 3-year window, I get different results. And he said, welcome to the world of model risk, right? So what do you have there? Model risk in red. So look at that top left, inaccurate parameters, inaccurate procedure. That probably wasn't my problem. Wrong assumptions, that might have been my problem. Back when I was in graduate school in, let's say, 1990, the Chicago theory was prevalent among all institutions that, hey, capital asset pricing model, this was the holy grail. That beta was able to capture all that kinds of risk, normal distributions, all that kind of stuff. Erroneous interpretation, I probably didn't suffer from that. But let's go ahead and combine all those under model risk. So I would remember all these: inaccurate parameters, erroneous interpretation. Now, of course, with all the training that you have reading these chapters, you're probably not going to have that erroneous interpretation. The procedure is probably going to be okay. We need to worry about that as well. Wrong assumptions. But as you'll see here in some of these examples, all of these combined, whether it's just one or two or three or all four of them, can really result in some problems. How about this Niederhoffer put option model risk example? So this guy, Victor, he had a successful hedge fund in the 1990s. And what he would do is he would write uncovered, which means he didn't own the share of stock, out of the money put options on the S&P 500 index. All right, so let's just suppose the S&P 500 index is, let's say, 3,000, and let's suppose that we write this out of the money put option with an exercise price of, I don't know, 2,800 or 2,900. And what are we going to do? Since it's an out of the money, maybe even a deep out of the money put option, that premium that we're going to raise is not very substantial, right? But what we're going to do is we're going to write lots and lots of these so that we can accumulate and we can raise some income so that we can invest that somewhere else. All right. Look at that first circle point. And we talked about this in other chapters with, value at risk and expected shortfall and all that other good stuff that we have talked about. The overriding assumption underlying the strategy is that a one-day market decline of more than 5% would be extremely rare. So look at the date. Of course, this happens. Of course, October 27th, 1997. I mean, I don't remember that date, but I'm sure Victor does. The market plummeted 7%. So what's going to happen on those? If you own that option and that option is expiring on October 27th or even the 28th, you're going to show up at Victor's door and say, hey, I want to buy the S&P at, what did I say, 2,800, and maybe it's 2,600 or whatever that is. So of course, since these were uncovered, Victor was forced to wipe out all his cash reserves, including his personal savings. Boy, that sounds painful, doesn't it? Here's one of my favorite examples, mostly because the board of directors was made up of Myron Scholes and Robert Merton. Of course, you guys know them as part of the Black-Scholes-Merton option pricing model, which won the Nobel Prize in Economic Sciences in 1997 for Scholes and Merton. Of course, Fisher Black would have been a part of that had he still been alive, but he was not. Now, of course, this hedge fund generated lots and lots of profits in its derivative trading. Look at that second block point there. 42%, 48%, 17% in the mid-1990s. And of course, this is after. Are you ready for this? This is after their management fee, which was around 20%. So I mean, this is really doing extremely well. Oh boy, let's take a deep breath. Now let's go back to this Black-Scholes-Merton option pricing model, and remember it needs 5 variables: stock price, which is easy to get; exercise price, which is easy to determine; time to expiration, which is easy to obtain; the risk-free rate of interest, all we got to do is look in the treasury market. That's easy. And then the standard deviation of the underlying asset. All right, so how do we get that thing? Well, the easiest way to get it is using historical data. Let me go back to the last, 5 weeks, 10 weeks, 20 weeks, 50 weeks. Let me compute that daily standard deviation and make the assumption that, the standard deviation is stable over time, and so that's going to apply to the future. So let's go back. Let me just go back here. Oh my goodness gracious. Wrong assumptions, inaccurate. All right, so what happens here? So of course, this historical model, which was based on, let's say a normal distribution or maybe a nearly normal distribution. And so there's no big fat tail, heavy tail on that left side that we talk about in value at risk. And so of course, Of course, one of those events occurred, and they had losses in the $3 or $4 billion range. Fed Bank of New York had to step in, as well as 15 commercial banks to save it. All right, so what are we going to summarize here? Reliance on historical models, over-reliance, right? Low frequency, high severity events were uncorrelated over time. All of these trading strategies relied on the assumption that the risk premiums and the market volatility would ultimately decline. Of course, that didn't happen. All right, so how do we avoid this in the future? Large-scale stress testing. I mentioned that just a few slides ago. How about an initial margin and then potential liquidation costs? Initial margin of derivative contracts should always be enforced. That sounds an awful lot to me like effective and efficient regulations. How about the London whale with model risk here? There was this guy named Bruno Ixel, a synthetic credit portfolio trader. What does that mean? Let's go back to our awareness and our knowledge of put-call parity. Remember, we said that the stock price and the put price must be equal to the call price plus the present value of the risk-free bond price. Now, what you can do is you can take those and move them on one side or the other of the equal sign, and you can synthetically create an option, a share of stock, or a treasury bill. And so what JP Morgan Chase tried to do was they wanted to invest their excess deposits of the bank. What this Ixel guy did was that he constructed a synthetic credit portfolio using put-call parity among other models to protect the bank against adverse credit scenarios, in particular widening credit spreads. And essentially what happened was that this looked an awful lot like a basket of credit default swaps. And these credit default swaps were written not mostly or mainly on individual issues, but on stock market indexes. Now, of course, in every scenario, this works really, really well. But over time, what's going to happen? Oh my goodness gracious. So what happened was that in December of 2011, the management decided to reduce the exposure and its risk-weighted assets following a more positive outlook of the economy. And so instead of unwinding these positions, which would have produced a little bit of a loss, they launched a strategy to try to recover those losses and then turn them into gains. And so this strategy ended up increasing not only the portfolio size, it increased the risk, and it increased the risk-weighted assets. So this net long position eliminated these hedging protections of the original SCP. And so this really reduced their ability to exit their markets without suffering losses. So here's kind of a summary here. Well, we're really subject to these rules of marking to market, but what we can do is we can set the marks that were at significant variance to the midpoints of those dealer quotes in the market. And so what we're going to do is this London whale painted a much rosier position and a much rosier picture than the actual real-time marking to market would have shown on the books. So there was really no availability to prepare those daily reports. There was no risk committee meetings. They were able to engage in speculative and risky trades. Speaking of risky trades, we talked about Barings Bank at some point in our life. Nick Leeson, the British trader. What happened was that not only did Barings say to Nick, hey, you know what, we want you to be in charge of all of our derivatives trading, we're going to allow you to monitor yourself. And so he essentially had the ability to create dummy accounts where he could put his losses into those accounts and prevent them from being seen by anybody else. Now, of course, you can only put so many losses into a special purpose vehicle until somebody asks the question, hey, what are all those things in there? And that ultimately led to bankruptcy. So look at the circle points I have at the bottom. Little management oversight, no clear demarcation of roles and responsibilities. And since Nick was in charge of the settlement operations, he could hide his trading losses from the main office. How about the two examples of Procter & Gamble and Gibson greeting cards? Procter & Gamble still exists today. Gibson greeting cards was taken over by American Greetings after this debacle. But essentially what happened here was that both Procter & Gamble and Gibson were trying to manage their interest rate risk on a fixed rate, relatively short-term note. In Procter & Gamble's case, they were trying to hedge about $40 million worth of an interest payment. It was a fixed payment. So what they wanted was to be able to, if interest rates fell, they wanted to be able to pay a lower rate. Gibson Greetings was in a similar case, but their amount wasn't even 40 million. I think it was 20 or 25 million. So they called Bankers Trust, and Bankers Trust said, yeah, sure, we can create a derivative security for you. It was actually a swap contract. And, the chapter doesn't really do this example justice. With a plain vanilla interest rate swap, the pay or the receive, fixed or floating, the difference is between a fixed rate, let's say 5%, and a floating rate, let's just say LIBOR. And so if LIBOR is at 8, then there's going to be a 3 payment made between those two parties, right? It's pretty simple to figure out. Well, in these complex derivatives, really, this is what Bankers Trust did. They made the payment depending on the difference between the yield on risk-free security and the price of some other kind of security. So it wasn't apples to apples. It was a yield interest rate and dollars of price. And so, of course, both of these companies could only lose if the window of interest rates fell within some small, narrow range at the date of the swap payments. And of course, both of these happened. Both of these occurred. And Procter & Gamble ended up losing about $400 million. How silly is that? $400 million of losses trying to hedge $40 million worth of an interest payment. And so they sued Bankers Trust. Bankers Trust sued back Procter & Gamble and Gibson. It was a whole brouhaha in these markets. And several executives, lost their jobs and were forced to pay some fines. But this goes back to, let me just swing back here quickly. This goes back to identifying the risk. Okay, so neither Procter & Gamble or Gibson could identify the risk. Quantifying the risk, they didn't do that at all. Now, they tried to manage the risk without really having knowledge of the identifying the risk and the quantifying the risk. And so, of course, that's not going to work. Remember, identify, quantify, manage. Those three go hand in hand. All right, how about a municipality? I'm guessing you guys have heard about this at some point in your life. Orange County case illustrates how complex financial products can ruin a municipality. Yeah, now look at this. So this fund that was run by the county treasurer, Robert Citron, had about $7 or $8 billion in equity, but this guy managed to borrow about $13 billion using the repo market and complex inverse floating rate notes. Now, Robert was betting that interest rates would fall, but he would also be relatively profitable if interest rates stayed low. Now, of course, what happened in 1994? The Fed announced a hike in interest rates, 250 basis points. Oh my gosh, this resulted in a loss of $1.5 billion. This was at the time the biggest loss in a municipality, and it might be even today, but Jackson County, Mississippi may have surpassed that. How about this Sachsen Landesbank way back in the 2007 financial crisis? Let's go back to this time period, 2004 and 2005. So you have these U.S. banks who were not only underwriting, but then distributing and packaging these mortgage loans, and they needed to sell them, right? And so they were willing to sell them to anybody. Didn't have to be U.S. investors. And so there were lots and lots of financial institutions throughout the world who loved buying these mortgage bank securities, in particular the subprime securities, because they had a much higher rating than they should have had. And so life in that subprime market was ripe for these European banks and other banks throughout the world, including banks in Iceland, to buy these mortgage-backed securities. Now, the problem with this Landesbank was that it opened a network of what it called conduits. And what it did, these conduits raised money through the sale of short-term debt. So imagining issuing a relatively short-term security like a 6-month bill or maybe a 2-year note, taking the proceeds and then investing in these subprime securities over in the US. I mean, this sounds like a great way to diversify the portfolio. However, of course, when the subprime crisis hit us in 2007, the value of those mortgage-backed securities, in particular those subprime securities, they fell dramatically. And this bank had to be sold to another financial institution. How about reputational risk? There are lots and lots of examples. The textbook talks about Volkswagen. In today's headlines, I'm thinking of Boeing. But what Volkswagen did back in 2008, 2009, and they did this for several years, is that they wanted to avoid being able to have their vehicles detected for pollution. Here in the United States, in particular Pennsylvania, I got to take my car every year to get an emissions test. And so they, run my car and they do some kind of emissions test. And I'm not quite sure how it works, because we've had a car for a bunch of years and it passes every time. So maybe they're making cars better these days. Of course, we don't have a Volkswagen. But the issue is that what Volkswagen did is they intentionally programmed their computer inside of their cars to reduce the emission when it was tested. So they could automatically produce an output that is, what does that say there? 40 times more nitrogen oxide. I have no idea what that thing is, but it sounds to me like we don't want lots of that in the atmosphere. Now, 2014, engineers in the United States carried out these live road tests. I remember seeing these on television, and then that scheme was unearthed. So this was untold damage to the Volkswagen brand name. I teach my students in my corporate finance classes, the goal of business is to maximize shareholder wealth. How do firms do that? They do that by branding their product lines. And so when those product lines become under fire because of reputation, then look at this. The share price fell by over 1/3, and then they faced lots and lots of fines and penalties. Those of you looking for a more recent example, just get up to date on Boeing. Read the Wall Street Journal. One of my favorite stories about corporate governance, since my dissertation was on corporate governance, was Enron. Now, of course, I wrote my dissertation in 1993, and Enron didn't have its problems for about 10 years later. But you think about this Houston-based company, which was really an energy firm. And like any good energy firm, it realized the need to manage its commodity price risk by using just simple oil futures contracts. And so over time, what Enron realized was that it could make way more money by trading futures contracts and other kinds of derivative securities than it could by going out and digging up oil in the field. Now, of course, this all works as long as those oil futures positions are in line with the promised branding and corporate governance issues that is part of Enron's business model. But as soon as those kind of decouple, then there's going to be a problem. And this is what happened. And so Enron started losing lots and lots of money in its derivative contracts. And it started hiding those into other places. And Enron really was the first time that I learned of the value and the pain of these special purpose vehicles. I bet you guys remember reading about Ken Lay. And also, one of the interesting stories about Enron is that, I mean, these people, look at the quotes there. Let me go ahead and read that. Falsifying Enron's publicly reported financial results and making false and misleading public representations about Enron's business performance and financial conditions. It failed to fulfill its fiduciary duties to shareholders. And it did this, maybe with the help of Arthur Andersen, among others. But the interesting story here is that, some of these people went to jail, but there was a married couple, who was all part of this. And the judge was very lenient in determining the timing of their sentences. He allowed the wife to go to jail for a certain amount of time. And then when she got out of jail, she let the husband go to jail because they had some children. How about this SWIFT case? SWIFT is this secure electronic platform that transfers funds between and among 11,000 financial institutions. All right, so what are we expecting? We're expecting that this network would be secure. But of course, an attack on a central bank that led to the loss of $81 million exposed a serious weakness in the system. I don't really know a whole lot about malware, but there was planted in there, and this really decimated the system. Reputational risk, etc., etc. And I think that takes us through these financial disasters. We covered every one of those cases. Good luck in memorizing all the important details about those cases, but also try to remember and try to be able to apply what that means for a fictional case on an exam question.